The story goes like this. In August 2022, Steven Lim actually shared in a podcast that he sold away his HDB flat, which fetched him $300,000, and he put everything into Singpost. Everything. Now at this point, nobody knows if he's saying the truth or not, or is he really just joking. And I actually did a review on this idea, mainly to critique on his approach and also to deep dive a bit on Singpost. Long story short, Singpost is now facing some decline because firstly, they own the postal service, correct? Now people are sending less and less letters to each other already. So there is a decaying industry. That has resulted in Singpost's operating profits to have been dropping over the last 5 years. Their dividends also has been dropping over the last 5 years. Then they own properties, which right now in high interest environment isn't too favorable. So net Singpost is having assets that is not really related to the new economy. Of course, they are trying to rechange it and become more e-commerce based. That requires them to revolutionize the business. So fast forward to today, Steven Lim has actually shared in a post that Steven Lim Koko has actually officially lost $120,000. Papa sorry, mama sorry. Sorry everyone from Steven Lim Koko. Today is a mixed feelings day as I officially lost about $120,000 from the $300,000 I put in to Singpost. Now it goes to show that he wasn't kidding back then when he said he went all in. So this $120,000 loss, there are lessons. That's why we are doing today's video, correct? Because instead of making these, let's learn from possibly his mistakes, just in case you are selling away your own HDB tomorrow, just in case you are going to strike Toto, just in case you are going to get a big inheritance. What kind of mistakes to really avoid? So back to Steven Lim. If you see in this screenshot, he's even put the trades there. So I think it's very legitimate. And if I were to match against Singpost's share price, it is indeed true that he probably really lost $120,000. You can see over there, Singpost has lost 40%. When he bought, it's around 65 cents. Right now, it's sitting at 40 cents. Actually, when he sold off, it's at 38.5. Question is, did he sell right at the very bottom or not? Just in, Singpost has announced strategic reviews, especially on their Australia assets. And any divestment news could be, special dividends to shareholders. That's why Singpost's share price has actually rallied in the last few days. A bit like what's going on in Singtel. Then in a subsequent post, Steven Lim has actually mentioned that with this $180,000 in his bank account, he is in a shopping mood right now and don't know what to buy. So please kindly advise what are our wise ideas that he can invest into. With that, it gives me context to highlight 2 learning lessons. Before I get there, smash the like button, especially like financial content like this. It helps you become a better investor and helps you avoid mistakes that would really put a detriment to your own retirement. The first is I'd like to recommend for Mr. Steven Lim to stop doing big swings in terms of how he approached his investments and money. Big swings apply not only on how you buy, but also how you sell. Don't sell everything 300,000 one shot because you never know. You can actually sell in pieces and it buys you time to think a bit deeper and make sure it's not a rash decision. Now, he's mentioned that he's in a shopping spree right now, correct? Slow down. Because again, wealth building is a marathon. The faster you want to do all-in bets and make big swings, the more it seems that it's going to get you into trouble. Investing really is not a gamble. And that's why I really think this whole discussion is important because it highlights a certain factor. This is actually called the financial thermostat theory, something I've covered before. Now for his case, I can illustrate. Maybe in his bank account, it used to be like 50,000 cash on hand. That is a comfortable zone. For yourself, you have a different level of comfortable zone. Then when he sold his HDB flat, 300,000 came in. Then he felt very wealthy, correct? Because he's comfortable holding 50,000. 300,000 came in, he's itching to buy things. Right now, the situation looks very similar. Instead of selling away his HDB flat, he has sold away his Singpost and is flush with cash again. Now, the meter again is in this green wealthy zone. And when you are in this zone, do note you are prone to feel wealthy and to splurge on things, whether it's investments, speculation, gambling, shopping, you name it. It's also the very reason why LV, Gucci, Armani, they are all around the casino. Once you win money, you feel rich, you want to splurge. It's a very basic psychological problem that we all face in one way or another. Now, I'll have these words for Mr. Steven Lim. Previously you have gotten $300,000 and you have whacked into a stock you probably never own, I presume. I'm actually not even sure if you have invested $300,000 before this $300,000 that you poured into Singpost. So again, avoid big swings, no more big wins, big losses kind of mindset, which means anything that is all in into stocks, property, or businesses. You may have celebrity friends that would like to introduce you to pour into their food businesses, which you have no idea, then the best way is to say no. Or just limit that to a 30,000 investment, something like that. No more big swings. Now, on the other hand, if you are doing well in your online sales on TikTok, on Instagram, then maybe this money is capital that you can pour towards that venture, but pour it slowly again, because money is like this. It's like fuel, oil into a fire. If you know how to handle it, it scales your thing, it makes you succeed faster. But if you don't know, that's where getting burned comes along. So go slow again, no more big swings. The second lesson to note is if you want to invest back in the financial markets, diversify properly and don't chase losses. Chasing losses is the fastest way to burn through the remaining $180,000. When you lose 40%, you realize that you need 67% gain just to recover back to break even. If you have lost 80%, you need a 400% gain just to break even, which shows you that at some point, the mountain is just so difficult to overcome, and sometimes it's better to write it off and start afresh. My message to him, and if you are in a similar situation, is to accept that this loss of 120,000, to build it back to 300,000, it is going to take years. If the rate of return is 8%, it's going to take 7 years. If the rate of return is 5%, it's going to take 10 years. 10 long years. Once you are aware of how deep the hole is and you are more patient, I guess that's a good start. All investors have losses. Good investors know how to handle them and know how to build wins that are multi-baggers that can cover these losses. For my own, it's quite obvious. I have one that's looking bad and losing right now. Mapletree Pan Asia Commercial Trust. 1 year ago, if you ask me, I would think it's a blue chip. I would still think so now. But if you look in terms of the price chart, you would see that it's a minus 30% for me, correct? Currently, I'm waiting for its Hong Kong and China assets. They own quality assets, which in my opinion are better than Singpost's. They own VivoCity, Mapletree Business City. The rounding points are, once you are suddenly flush with money, don't go all in. You're not there to gamble and be the best investor of the year. You're there to invest for long-term returns and to build wealth for yourself and your family. It's much better to tell Papa, Mama, I'm bringing you on a holiday with my dividends. That is way better than to apologize them that you have burned through some capital and not looking too good. And not going all in also means you understand the value of diversification to cap your risk level at certain points, because Mr. Market is very humbling. The journey is never smooth sailing. I thought China has bottomed. It hasn't. I thought REITs has bottomed. Maybe it does, but it's still not looking really sunshine yet. Decide also if stock picking is suitable. If not, go with a broad-based approach. These are funds that I've imputed for private clients that give them broad-based equity exposure and dollar cost average patiently. The game is always to stay alive. Luckily for his case, there was no leverage. If not, even this 180,000 could have been gone. If he has a chance to listen to this, hopefully he can avoid some mistakes, and I really wish him the best. With that, I'd like to invite you to two of my previous tutorials. The first is top 5 dividend stocks. I'll see you in either of these two. Take care and invest safely as always. Goodbye.